Good morning, Professor Blundell, Associate Professor Sawani Thai Lungrod, the President of the University of Thai Chamber of Commerce, honorable guests, ladies and gentlemen. On behalf of the University of Thai Chamber of Commerce and the Research Institute for Policy Evaluation and Design, I'm greatly honored to welcome you all to the conference on tax reform, the empirical evidence lessons from the Mirrlees review. It is our great pleasure and privilege to have Professor Richard Blundell with us today. Professor Blundell is a leading economist who specializes in economics of taxation. He is currently the Ricardo Professor of the Political Economy at the Department of Economics, University College London. Also, he is a research director of the Institute of Fiscal Study, or IFS, in the United Kingdom. Before we formally open today's events, I would like to briefly inform you about our program. We will start with the opening speech from the President of the University. The President's speech will be followed by Dr. Virachat Kilentong talk to introduce you the University News Research Center called Research Institute for Policy Evaluation and Design. And then Professor Blundell lecture will follow Dr. Virachat talk. And now I believe it is a good time to start today's event. I would like to invite Associate Professor Sawani Thai Lungrod, the President of the University, to formally open our conference. Thank you.
Good morning, Professor Blundell, guests, ladies and gentlemen. On behalf of the university, I am very honored to welcome you all at our University of the Thai Chamber of Commerce. It is my great pleasure to have Professor Richard Blundell with us today. Professor Blundell is a leading economist who is renowned for his contributions to the successful tax reform in the UK. As we know, our societies could not be this developed without tax system. The way in which tax systems are designed matters greatly to our lives. Taxation raises large amounts of revenue to pay for our public services like healthcare, education, security, and many public facilities, engaging our modern day life. Without taxation, one could not imagine how the modern society would operate. Unfortunately, policymakers rarely stay back to consider the design of the national tax systems as a whole. The public understanding of taxation is very limited, and the political and public discussion of tax design is still inadequate. I hope that Professor Blundell talks today will raise our awareness as well as understanding of how important is tax system design. Moreover, today's event will offer you a unique opportunity to share your experiences, your ideas regarding taxation and tax reform, which is definitely the topic for anyone who cares about the future of the country. I would like to thank you all for joining us today. We truly value your participation and support to this conference. I am sure that this conference will be a memorable, highly educational, and not to be missed event. Last but not least, I would like to thank Professor Blundell for your devotion and your contribution to the study of tax reform, and especially for being with us today at the University of the Thai Chamber of Commerce. Thank you very much.
Thank you, Associate Professor Sawani Thai Lungrod. Next, I would like to invite Assistant Professor Virachat Kilentong. Dr. Virachat is the Director of the Research Institute for Policy Evaluation and Design. He will briefly talk to you about what we do at the research and also about the Ph.D. program in economics at the university. Please welcome Dr. Virashad.
Thank you. Good morning, Professor Blundell, President Sawani, honorable guests, ladies and gentlemen. The Research Institute for Policy Evaluation and Design, or what we call RIPED, aims to be the leading interdisciplinary research institute in Southeast Asia. Our immediate priorities are to build research capability and enhance research reputation by publishing in high-quality peer-reviewed journals. Our long-term objective is to maximize our impact on public policy through independent and impartial policy evaluation analysis and rigorous policy designs. Again, publishing in leading academic journals is the best way to ensure the soundness of our methodology and the quality of our findings. The interdisciplinary research fellows enable RIPED to cover a wide range of relevant policy issues. At the same time, each research fellow's interests are very focused. Researchers at RIPED continuously improve their expertise by conducting rigorous research and presenting in internal seminars as well as international conferences. To help our research fellows to produce cutting-edge research, RIPED has established a close collaboration with Professor Robert M. Townsend from the Massachusetts Institute of Technology, and periodically invited academics and experts from around the world to visit the institute. This gives our researchers a unique opportunity to work closely with the world's leading scholars. RIPED is currently running a quarterly panel survey of approximately 2,400 households, what we call the Thailand Enterprise Panel Surveys, or TEPS. TEPS is funded by the Templeton Foundation through the Enterprise Initiative, the Melinda and Bill Gates Foundation through the Consortium for Financial System for Poverty, and the University of the Thai Chamber of Commerce. This survey is unique in that it strikes a balance between traditional firm surveys and household surveys. The survey collects not only detailed household information, but also throughout set of firms-related variables. TEPS data offer great opportunities for researchers, our research fellows in particular, to investigate and better understand the roles of financial system, family networks, and technology on economic development. This body of knowledge from research will provide the basis for our robust policy recommendations. In other words, we would like to have research to guide policy, not the other way around. RIPED is also working closely with doctoral program in economics at UTCC. This year, we have revised our program from the dual track to the doctoral program. This revision should reduce the time needed to complete the program. This program has a number of scholarships available for qualified students. We are also awarded a Royal Golden Jubilee Scholarship, which is available to an outstanding student and will cover tuition, fees, and monthly stipend. Moreover, this scholarship will give the opportunity to students to go visit and study and conduct research at our network university abroad. In addition, throughout the year, we invite Thai and foreign scholars to present their cutting-edge research in our monthly economic seminars, which every one of you are invited to attend. The student will also have a unique opportunity to interact with these prominent scholars. Our students will also have opportunity to access to resources provided by the University of Chicago UTCC Research Center, which collects a wide range of Thai economic and financial data. Of course, if you're interested in, you can talk to Dr. Ash Praveenawat, who is the director of the program here. And thank you.
Thank you, Dr. Virashad. Now I think is the time that everyone has been waiting for. Today, Professor Richard Blundell will give us a talk on tax reform and empirical evidence, the lesson from the Mirrlees review. Let me briefly tell you what Mirrlees review is. It is a terrific achievement, the most thorough and clear-sighted assessment of the United Kingdom tax system we have seen for decades. The Mirrlees review focused on the reform of the taxation of earnings, savings, and consumption. Also, it discusses the role of empirical evidence in coming up with a recommendation for the overall direction of the tax reform for open economies. After Professor Blundell talk finishes, there will be a question and answer session. So now, please welcome Professor Richard Blundell.
Thank you. Thank you. Okay, so I'm going to talk about the Mirrlees review, but a little bit of context. So my talk is more directed at the empirical foundations of some of the research and reforms. And so this follows quite nicely the introduction of how you should do good research, an interaction between empirical evidence and theory, and hopefully some good policy design. So what am I going to do? I'm going to give you a little bit of background to the review. Then I want to go through the broad set of ideas and principles behind a good tax system that we used in coming up with our reforms. Discussion of the role of evidence in the proposals. And then look at some specific proposals, see how they worked out, and give you a bit of background there. The Mirrlees review, the idea really behind the review, in fact, was to assess where we got to with thinking about tax reform. So it's built on a large body of economic theory and evidence. I'm going to stand here so I can see what I'm talking about. It was inspired by the Mead Review, which you may or may not know, but the Institute for Fiscal Studies was started as a part of the Mead Review, in fact. So the Mead Review happened around Mead Report about 30 years ago in the UK. Mead was also a Nobel Prize winner around the time or shortly after this report came out, and it was the principal argument for moving towards a consumption tax, one of the first kind of coherent reviews of reform that would push you in that direction. And in fact, it had a big impact around many economies, in particular in the UK, but also in North America. On that particular review, there was 3 young researchers. One of them was Mervyn King, another was John Kay, and another was John Fleming. They're all well known in public finance. Mervyn King's the governor of the Bank of England, of course, now. John Kay became the first director of the Institute for Fiscal Studies. And very soon after that, when John stepped down, we moved the Institute into having a research director and a director, partly because, and T, you may learn from this, that it's very hard to be both things when you're trying to run a research institute. There are different clients that you need to deal with. There's academia, there's of course journals, and then there's the continuous demands from media and policy circles. Of course, you want to give those even weight. And in fact, they should have even weight. Both sides should respect each other. It's very hard for that to come from one person. And indeed, part of the success of the Institute, if you're ever looking at it, is that it tries to get this balance right. People have different comparative advantages, and the idea is to get them working well together. Typically in academic life, you don't always see that happening. And one nice key feature of what Rob Townsend has done with you guys and with his work generally is to get a nice balance of theory, evidence, and policy. And that's really what's going on here. Interestingly, if you look back to when this report was written, there's absolutely no evidence used in it at all. It's just kind of pure intuition. And you can get a long way with intuition and theory. And what we wanted to do in the review was say, well, what have we learnt about from the theory and evidence that's happened subsequent to this? it gives you a nice grounding. 3 decades of economic research, what's happened. Of course, what's happened, or had happened almost at that time, was Jim Mirrlees was writing about optimal tax and tax design, and so we asked Jim to be the chair of the committee. By the way, this is not a government review, it's our own review, completely independent, and Jim agreed, and I'll tell you a little bit about how it was set up. It's a review of tax design from first principles, and the idea was to look at open economies. By the way, the Mead review hardly mentioned international or open economy, very closed economy kind of thinking. The UK is the kind of subject, but it's really a laboratory, a bit like Rob is using Thailand, visit villages as a laboratory. You know, you have to understand the institutions and the data you're working with, and you know, many of us, or my colleagues, have studied the UK, and it works as a nice laboratory, but we draw on evidence from all around. Typically on modern developed open economies, but in fact many of the principles are there for any kind of growing open economy. And I was saying at tea that there's a lot of interest now in looking at economies that have grown from kind of middle income on their way up, as it were, and how you reform tax system to cope with a modern open economy. The focus is on evidence-based policy, and that's what we do here. I should add that, you know, you can't conduct a review without talking to tax experts of all different kinds, and in fact, if you wanted to spend your time reading about what we had to do, we talked a lot with the Treasury, with the EU, and with IMF about what we were doing and how you could think about implementing it. Of course, I'm not going to be able to cover everything here by any means, so if you want, you can read it. Actually, I gave T a copy of the book, so there are a number. I'll tell you a little bit more as I'm going on. Oops, wrong way. How about getting rid of that? That's okay, don't worry. Here we go. There's, in fact, 2 volumes. I'll get down to some details in a minute. 2 volumes. The first one is quite a fun volume. It's a huge thing, one of the biggest I've certainly ever been involved in. And part of that was just we asked a huge number of people who we thought were experts across different fields of public economics relating to different aspects of the tax system to write about it from their own perspective and work with young researchers at the Institute to bring in evidence from the UK but other countries. So the idea was to get young Ph.D. students and researchers working with the top experts around the world, and I think absolutely everyone we asked said yes, and this is one of the great things about having Mirrlees on your chair of the group. So you'll find in the first volume commentaries by, you know, Bob Hall, you'll find Hannah Nowback, many well-known people, Peter Diamond, lots of different perspectives, I should add. And there was no insistence they should all agree, and they don't all agree, of course. And then the second volume, Tax by Design, which we published in September this last year, was trying to bring some coherent view of tax reform with all the evidence and these different views. So that's what we produced. You can buy it from OUP, or you can download it for free. Everything's free on the website, and that was part of the deal. So there's a website. If you want to follow anything up here, you can look at that, and it's got all the commentaries, all the discussion, and what have you. So that's a little bit of background. You could ask why another tax review. Well, one is just changes in the world. The world's become a very different place, and we couldn't find all the things we wanted in the current set of reviews. I should add, these reviews are written for a policy audience. They're based on relatively technical work, but there's nothing technical in the reviews themselves. They're completely readable. I think there's almost no equations, and we've kept jargon down to a minimum. The idea was to have an impact as big as we could. So therefore, effectively for an audience who may have some background in economics as an undergraduate, but nothing more. Changes in our understanding. Of course, we've rethought a lot of the tax design issues, and you'll see how some of that comes up. By the way, I'm not going to give a technical talk, but I'm, of course, much happier giving a technical talk. So if anybody wants to ask technical questions, I'm delighted. What I was going to focus on, though, in the short time I've got, because it's been quite an interesting thing to think about, was how evidence was used in the review. That's not something we focused on in the review, and so this is more a reflection. How did we think about using evidence? Why was it useful? We collect a lot of data. You're collecting a lot of data here, and you often think, well, how is it going to be used? How best should it inform policy? And that's the kind of questions I want to look here. The red doesn't show up too well. I hope you can read this. The slides, oh, you may have the slides anyway. That's good. The evidence I'm going to feature are on things more to do with household design of household taxation. We cover in the review a lot of areas, including environmental taxation, a lot on corporate taxation, but I haven't got time to discuss them here. I should add, though, the idea is to have an integrated picture. And in some sense, one of the things that perhaps this review does that many others don't is come up with reforms that are fully integrated. So corporate and personal taxes in the reform packages we look at are completely integrated, and that's quite important. But of course, as you're building those up, you look at particular areas. What have we learnt? Well, one thing we've learnt a lot about is how people behave in the labour market subject to taxes. How do they respond? We don't know everything, of course. We're learning all the time. But we know quite a few things. And one thing about that we've learned is that in general, people operating in markets, because of fixed cost of entry and other types of things that deter entry differently to the way you behave when you're in a market, the extensive and intensive margins are different. That is, the way you respond, people respond as they're going in and out of work or thinking about going into work or changing occupations to the tax system is rather different to the way they think about it when they're deciding how much effort or how much in terms of hours or whatever their input is, their supply input is. That has quite important impacts on tax design. In a simple sense, it's the difference between average and marginal rates, but of course it's going to be quite important in thinking about taxes that affect the entry margin versus the intensive margin. And in the labour market, that's a key issue, because we have many, many policies that affect being in and out of the labour market very differently to the way they affect the amount you pay in effective taxes as you increase your supply of labour, if you wish. Also, we know that responses differ by age and demographic structure generally. For example, it's typically the case that that individuals are relatively responsive around retirement margin, in employment around retirement, but not at other times in their life. You get more responses around retirement than you do at other points. That might make you look a little bit about the way the tax system integrates with Social Security or pensions and provides incentives around retirement. And typically what you find is that most tax systems provide the highest disincentives to work around the period of retirement, exactly when people are most sensitive. And so there's a good reason to think of reforming things around that margin, and I'll show you how we did that. Taxable income elasticity is a very popular field in empirical public finance now. That is quite simply how the revenue that the government gets from any individual or any group of individuals, a village, a family, varies with the tax rate itself. Okay, so if I change the tax rate, how much taxable income do I recover? That's a taxable income elasticity, and in some sense that's a direct measure of the value, if you want, of that tax reform, and that's going to be quite an important parameter. And particularly it's the case for looking at margins where it's very difficult to measure the effort or input that an individual or a firm is making. And so You might look at, if you're looking at, say, self-employed, it might be very difficult to measure exactly how much effort is going into their particular work or their firm, but it's not so difficult to measure how responsive the taxable income is to changing the tax rate that they face. And I'll come to how we might use that. Particularly at the top of the distribution, that is, by the way, and at the and around self-employment. Consumer responses to indirect taxation. VAT is a very, very popular area for reform, and we've learned a lot about how consumers respond to indirect taxation, and in particular the interaction with the labour market, and that turns out to be quite an important design issue. In fact, one of the reasons, or perhaps one of the main ideas behind having different VAT rates on different goods is the way that the consumption of those goods relates to the labour market. So in a very simple sense, the reason you might not have such a high VAT rate on the consumption of, say, childcare or transport might be because those two are complementary with work, and you might optimally have a lower rate of tax on those kinds of goods. That's an old result from Atkinson and Stiglitz, but it's valid. Its validity stands quite well. Intertemporal responses, exactly how we think about the taxation of savings depends on how individuals respond over their life cycle to taxes when they're thinking about their saving and investment decisions. So all these things have happened. We've learned a lot about them. We're going to use a lot of evidence and think about how this influences our tax design problem. I should add, of course, one thing that's happened, I don't know whether you do this here, but I imagine it's part of the program of research, is that you can simulate broadly what happens as you make tax reforms, say in a village or among a group of households. You change the tax system. You can work out in a very simple accounting sense who gets affected by those, which types of activity, at least in a first round kind of way, and then look at the effect on marginal and average tax rates and simulate policy reforms. This is a very straightforward thing, relatively straightforward thing to do now. Even 10, 15 years ago, this was a hard thing to do, and that's just a technology change, really. The principles, let me start with some overlying principles. In a sense, there's no empirical evidence used here. These are just the way you might, as economists, think about tax reform. And the first thing that the tax system is a system. And this is pretty important. Taxes, the way you think about an effective tax rate comes from all the different ways it affects a particular behaviour. So you can think about the tax system as a whole. The marginal tax rate is the sum of all additional taxes paid as income increases. And this is going to involve all the different types of taxes that affect income, whether they're paid by the employer, the consumer, the income earner, and we'll be thinking about what might be called the whole tax wedge. Doesn't mean to say we want to treat them all the same way, but nonetheless we want to look at the whole wedge. It's become very popular in some sense, in not such a progressive way, for evaluation to look at specific reforms. And in fact, in some sense, the policy evaluation debate in applied economics has tended to look at specific reforms. Might be a tax credit change or a tax change here, and not really look at the way it interacts with other taxes in the system. And I'm going to give you some examples of where that's a very bad way to think about tax evaluation, tax reform. It's a good idea to think of the system. Particularly then when you think about you want an overall progressive or some overall green structure to the tax system, which might be quite reasonable, but it doesn't mean to say that every tax has to be progressive and green. And a good example, this is pretty important in the policy debate. It's obvious to economists, but it's not so obvious in the political debate, and it's a very hard thing to get over in the public debate. And one of the ideas of the review really was to re-emphasize looking at the whole system and not to pick on particular taxes. one reason we find the tax system to be rather incoherent in some ways is that often it's the case that many different taxes are all trying to achieve the same objective. Some of them do them much more efficiently than others. So there are good ways to redistribute and there are rather poor ways to redistribute. And all we're worried about is the redistributive function of the whole tax system. And we'll look at that a bit. Neutrality is an old-fashioned but still a good guiding principle here, that not to discriminate unnecessarily between similar activities. And this is a kind of obvious point, but it's a key point really, and it relates very, very much to the system case as well. What you find is that once policy evaluation starts looking at specific little taxes, you get strong policy arguments or strong arguments for changing one small part of the tax system. Then you find that in fact you have a rather unneutral tax system. And a good example would be the way capital taxes and different assets are taxed. Typically you don't want to tax incomes from very similar sources in a very different way. You get, of course, just movements across those in an inefficient way. And a good example would be the way housing is treated differently from other capital, how capital gains is treated differently from other capital, dividend income, for example. And one of the ideas of the review was to try and look at neutrality generally and only argue for deviations from neutrality when the case is strong. A good example would be the taxation of childcare, for example. There's a good case for non-neutrality between childcare as a good and other goods. But many goods, there's not much of a strong case for differential taxation, and you'll see how this works. And then finally, progressivity. So these are three key kind of principles, if you want. There's nothing fancy or new about this, but it is a nice way of thinking about the whole review. When we looked at it's always good to stand back and look at what the tax system looks like. I probably could do this for any tax system and we come up with exactly the same point. The tax system in the UK has certainly been looked at over many years, but you still find that it has certain characteristics that are rather unattractive. For example, it doesn't work as a system. This seems to be true of many tax systems. There's a lack of joining up between the welfare system, personal taxes, and corporate taxes. And, these are kind of obvious points, but they come from these piecemeal reforms to different parts of the tax system without thinking about the whole tax system. And, of course, politicians like to play around with particular parts of the tax system. And so a good research outfit like IFS tries its best to point out this isn't always a wise thing to do, and you'll see how we do that. It's not neutral where it should be, and I'll give you some examples. Of course, it's well known that most corporate tax systems favour debt over equity, just in the way interest payments are tax deductible, but the equivalent payment on equity is not. And so there are many non-neutralities that lead to distortions in the way companies finance themselves, and other inconsistencies across savings taxes, and I'll look at those in a bit of detail here. And it's not well designed to deviate from neutrality where it should. Clearly we think of environmental taxes as a very good case for deviating from neutrality. You think of environmental bads as something you want to tax, and that can be a deviation from neutrality. But we end up with very different tax rates on carbon, for example, and we in the UK, and I'm sure it's true in Thailand, don't tax or even understand the way we should tax congestion, in particular road congestion. One interesting feature of the review I'm not going to talk about, but when we looked at environmental taxation, it's quite clear that the taxation of cars is much more heavily biased towards the taxation of the fuel that's consumed rather than congestion. And whereas congestion is clearly the big externality in somewhere like the UK, we have a very, very high fuel tax, which is way higher than any other tax on carbon in the economy, and we have a very low tax on congestion, and these are examples. It doesn't achieve progressively very efficiently. Still, it's the case in many economies, and in particular in the UK, that indirect taxes are used as a way of redistribution. For example, there's no tax on food eaten out of food in restaurants is taxed, but food taken out at home is not. And there are much better ways we're going to show to achieve redistribution without playing around with the taxation of different commodities, and that's something I'll look at. By the way, this becomes particularly key when you're increasing the VAT rate. So when VAT is at a low rate, lowish rate, like it is in Thailand at the moment, some of these distortions are relatively small, I guess you could say. What's happened in the UK, VAT started in fact at 9%, it's now 20%. And these differentials now, the differential between 0 and 20 is huge, of course. And as there's pressure to increase the VAT rate, it becomes even more important to try and correct these inefficiencies. And that's had surprising impact in the debate, actually. The broad proposals, what I'm just going through the proposals you'll find in the review, and then I'm going to look at some detail. But these are all pretty straightforward proposals, and we go through them in great detail, but they make a lot of sense, actually. The first one actually was enacted almost immediately and will become law in April. And that is the benefit system is a complete mess of different benefits, and you'll see lots of different effective tax rates in the system. And it's pretty obvious that you could achieve everything through a single integrated welfare benefit. And we suggested a way of designing that, and that's been taken up actually in policy. And so there's what's called a universal credit, which is now will be part of the tax system, welfare system in April. Less aggressive means testing, as you'll see that in a system that tries to redistribute a lot, of course, and target, you get particularly high tax rates on low earnings. And there's a question, how would you like to redesign those? Are those optimal in some sense? Is that the best way to think of taxing low incomes? After all, you do want to redistribute. And we come up with a set of reforms that reduce the means testing, at least for certain types of individuals. And you'll see how that comes from the evidence. And then aligning tax rates across employment and profits. It's a controversial thing to do. But in fact, we argue there's a very good case for it, because the way the empirical evidence came in here was we look at several reforms that have changed the relative tax rates across capital gains, different forms of incorporation and labour income. And what happens is this huge switch in organisational form across as you change these tax rates, but almost no change in the actual productive output. And so this is just an inefficient way of discriminating. And of course it means that if you increase the tax, for example, on employment, people shift to another source of income, shift their income from employment to another source, which you can do quite easily if you're self-employed, for example. And that means that the effective tax elasticity is much higher than it need be, and I'll give you examples of that. Neutrality, well, these are just two in the consumption section and in capital taxation, and I'll explain a little bit on that. And then deviations, well, there's obvious deviations, one on congestion and also on regular greenhouse gas emissions. Some deviations, like a zero rate of VAT on childcare, that's to line up with the complementarity with work. It's an obvious point. And special treatment for pensions, because there's a good reason why you might want to incentivize pensions slightly different to other kinds of saving. And of course, there's progressivity. And here's where a lot of the empirical evidence comes in. It's kind of interesting. In a theory world, of course, we talk about incentive compatibility constraints, but of course, empirically, we talk about response elasticities. And they're exactly the same things. So incentive compatibility constraints are really the constraints on the system because people adjust their behavior when you change taxes. That's exactly what empirical evidence is about gathering a lot of the time, just to figure out what those elasticities are. And so we kind of bring some empirical, if you want, foundation to what is a fairly standard idea in tax theory. Ah, that's wrong again. Ooh, bad. Sorry about that. I'll learn how to use this in a minute. So how did we, this was, when I was thinking about this, I was trying to think, well, how did we get to these proposals? What would be, what steps are involved? And in particular, in the way we use empirical evidence. And looking back on it, and I think this is the way we think about doing research in this area generally, there are kind of 5 steps, and it's kind of nice to think of these steps as you're kind of planning policy research of this kind. Firstly, just think about the margins where adjustment to taxes could take place. I mean, very simply, if you want to look at the places just through descriptive work where the variation really is taking place. If there's very little variation, then there's going to be very little to be thought through in terms of efficiency gains to tax reform. So you really want to look at where are the variations taking place. I call those the key margins of adjustment. I'll go through this in detail. The next step is just trying to figure out what the tax system is doing in terms of incentives. It's a little more complicated, of course, than you first think, because you've got to work out exactly what the effective tax rate is on a particular activity. I notice in the data that you collect on villages, there's quite a lot of work done on that. If we put all the tax system facing individuals in or households in the villages, what exactly is the effective tax rate on a consumption or investment activity? It's an important thing. This is one thing economists typically think about much more than others, and it's a key point. Of course, one problem with it, and one criticism of the standard economic approach, is that when you gather all different taxes together, you have to think about information, complexity, and salience. Not everybody thinks of different taxes in the same way. And of course, governments exploit this all the time. Some taxes are less salient than others. Typically, income tax is the most salient in the political sense, and it's very hard to change or increase the income tax rate. And in fact, you'll find governments playing around with reducing the income tax rate, but increasing, say, the tax on employment earnings through the direct tax on firms, for example. But in fact, the effective tax rate on earned income stays the same. And so you can see that salience is very important in the political economy of tax reform, as is complexity. So if we have a complex design to the different parts of the welfare and tax system, which most economies do, there's good reason to think about how reform would affect that. And in particular, how individuals think about an effective tax rate may be rather different to the way economists think about an effective tax rate. And we have to take account of that. And I'll give you some example of how we do that. That's quite a complicated thing to do empirically. But of course, we know that, for example, some welfare benefits that seem to make individuals better off are not always taken up by individuals. And so is it information or salience or what? And some tax credits that could be taken up by individuals for investments or work are not always taken up. And so we have to worry about that kind of side of things. Once you put those together, then you get to the more standard causal econometric analysis, which is different to the key margins. Margins are just looking at descriptive analysis, which is fine, of course, but it doesn't really tell you what you need for policy analysis. What you need for policy analysis is how big are the actual responses themselves. That's a kind of causal response. So if I change this tax rate, how do people respond? That's a very, very hard thing to measure, of course. And that's where good econometrics and evaluation techniques come in. And we spend a lot of time worrying about that. And then finally, you get back to bringing the theory together with those four elements and come up with some tax reform package. And that's what the Mirrlees model does, in fact. So we thought Mirrlees itself is quite an interesting case to take. Effectively, when you've got the size of responses together with the effective tax rates, then you can think of, given some social welfare function, what would the optimal tax reform look like, tax system look like. You have to be a little careful with that, and so the way we come up with our reform package is say, well, different governments will have different social welfare weights. What we want is a set of reforms that's going to be broadly attractive. They're efficiency gains that would be the kind of reforms you would want to do if you're whether or not you put a high weight on redistribution. So the nice thing about Mirrlees, of course, is the way it thinks about the balance between efficiency and redistribution, and that, of course, is going to come out in this kind of reform package. So there are our ideas. So let me look at some specific examples of how we did this. I'm going to focus on the taxation of earnings. It's something I've worked on, but I'll come to other issues around indirect taxation and taxation of savings. This is where I could have been a lot more technical than I'm going to be, and it's definitely the case that the background to this review used a lot more technical evidence than I'm going to produce here. The reason I like it is that, part of the fun as an economist, as an academic economist, of doing this kind of work is to see the interplay between theory and evidence. It's almost the motivation for doing research anyway, and it's a key part of this. Earnings taxation is very nice for this because we have a fair amount of evidence and we have quite a lot of theory. And on top of that, earnings taxation has to do a lot of work in any tax reform. It's always going to take most of the strain in the redistributive package through taxation and welfare, and so getting it right is absolutely key. The first thing to notice is the key distinction between the extensive and intensive margin. Why does that come up? Well, let's look at, this is not Thailand, this is the US, France and the UK, but it's quite an important, this is the kind of descriptive analysis you might start with. This kind of thing has a big influence, in fact. What this is the employment rate by age. Don't really have to see, you can see, broadly speaking, from teenage through to past retirement. The employment rate in the US, France and the UK just before the recession hit. When we're talking about tax reform, we're talking about relative buoyant periods of the economy, long-run structure of taxation, nothing to do with fiscal stimulus during recessions. And so this work has typically looked at the longish run reform and looking at relatively buoyant periods in the economy. So you always see data from relatively buoyant times in the economy. You can see here this tells you employment across these different. One thing that's clear is the employment rates for most men from age about 30 to 55 in these three economies are pretty much exactly the same on average, which is pretty shocking, actually, that they're so close. After all, the tax systems are quite different, actually. And this immediately tells you that there's not much action on the extensive margin for these guys in the middle, at least on average. There might be some specific groups, but where the action's going to be is around retirement, if there is any action, and around work to school choices. That's where it's going to happen on the extensive margin. You mustn't forget the intensive margin. The US work a lot harder than everybody else in terms of just pure hours of work. In fact, it's the outer envelope across the whole distribution. and the French work a lot less than everybody else. Of course, that's not such a bad thing, maybe. But it does tell you that you shouldn't focus just on the extensive margin. The reason I raised that, a lot of the empirical work on tax reform has spent a lot of time emphasizing the extensive margin, including among macroeconomists on tax reform. And you must remember that the intensive margin can be quite important. And so here again, there's going to be a balance between what the tax system is doing at the intensive margin and the extensive margin. And you can see from these that there's going to be a balance in some sense that changes with the age of the people you're looking at. And so you might want to focus the tax reform around particular groups, for example, pre-retirement and the way the tax system is affecting retirement, school choices. But don't forget the intensive margin. The same's true for women, actually, surprisingly, very similar, in fact, and I won't go through the detail, but there's a lot of evidence. So what I meant to say just by showing this is that when you start this analysis, you want to be just broadly descriptive, really. Just figure out what's going on in the data on each of the areas, whether it be employment, hours of work, savings, investment behavior, and you'll find in the review lots of kind of data that's salient to particular taxes or particular behavior, and that's important. And from that, we're going to learn about actual behavior. I'm going to, in some sense, skip all the analysis that goes between the descriptive analysis and the causal analysis. What have we learnt from that kind of data and then doing some more rigorous work? Well, generally taxes reduce labour supply. Substitution effects are generally larger than income effects. Not always true, in fact. That's going to be quite important, and I'll come to that. There can be an income effect, of course, for those in work as you increase taxes, and there can be a substitution effect. And both of those matter in tax reform. And I'm going to spend, that's a kind of key point here. Especially for learners, for low earners, responses are larger at the extensive margin than the intensive margin. So it is true that when you look at the responsiveness of individuals, certainly low education individuals, it's the extensive margin getting into work and out of work, at least for some groups, that is particularly responsive to the tax system, interestingly. And more extensive, and I'll give you some examples of that. And the responses are largest for particular types. For example, around women when children are going to school. We know this from lots of work that there's high elasticities. And those age over 55. The reason I've chosen those two is that in most economies, in fact, they're exactly where the highest tax rates are placed in the earnings tax system. And you can see why they might be, and that is they're exactly the groups you might be redistributing towards: mothers with children, families with children, and older people. You're trying to redistribute towards that group. Of course, if you redistribute towards a group and you want to then withdraw it as their income rises, then you're going to have them facing some very high tax rates, effective tax rates. And so you get a balance here. What the evidence says is that you must be very careful where you place those high tax rates, because if you place high tax rates where responses are higher, then you can get a big deadweight loss from the tax system. And that's exactly where the balance has to come in. And you'll see some reforms there. Other responses matter, and I'll come to how we think about taxing the rich in particular as an example, as it's such a controversial thing, certainly in most economies, actually. But if you put together the evidence, and here's broad perspective of what elasticities look like. One is there's no one elasticity that's very variable. Here's a distribution of extensive elasticities. It's not very informative, it just tells you what we find. This is on the extensive margin, work or not, across the whole distribution of individuals, going from hardly any response right down to zero, right up to a high response over one elasticity. And it's finding out which individuals, of course, which types of individuals are most responsive that's going to be key here. If you look at the intensive margin, it's much smaller, much more concentrated. So it is true that the extensive margin dominates the intensive margin, at least for some types. That's kind of interesting because it turns out the extensive-intense difference is key in understanding responses to reform. And in modern tax theory, it's become a very, very important part of the debate. There's some great papers by Sayers. One is John Bates Clark for this result, and LaRocque has his presidential address to the Econometric Society all about this point. They're both really theory papers, but they're very important. They're very recent. And what they say is that even if you're trying to be quite redistributive, if you have a very high, relatively high extensive elasticity, then you might want to place a higher transfer to lower wage workers than those out of work, which of course isn't what you would get immediately out of a standard Mirrlees model. By the way, the original Mirrlees model doesn't allow for this kind of policy. And in fact, what this kind of policy does is like a tax credit to low earners. And you see earned income tax credits in many economies. In fact, it's almost the biggest, one of the biggest tax reform movements you see in most modern economies is a move to have tax credits focused on low-wage workers. And that's a recognition that the extensive margin is important for them. And what the theory, together with this evidence, suggests is that's a good idea, and we spend a lot of time thinking about how to get this balance right. But a tax credit means that you get a bigger transfer as your earnings increased, at least for low earnings. That's a negative marginal tax rate. And one thing you learn in the original Mirrlees model is that it's never optimal to have a negative marginal tax rate. So, and this is kind of interesting that how could that be? Well, it turns out that if you distinguish between the extensive and intensive margin in any market you're looking at, then that completely changes the Mirrlees analysis, and it's quite sensible to have a design that can have a tax credit. And so much of this review is about where you would want tax credits and how to design them, whether they be for different markets, for firms, or for the labour market. And it's a pretty important side of tax reform, in fact. And what we argue is that for some workers this is a very important thing to implement, but not for all. It depends where we think the elasticities are largest. So here's a real bit where evidence is absolutely key. If you don't have the evidence, you can't design things. On the other hand, if we didn't have the theory that was behind this, we wouldn't have a very coherent view of how this works. So this is a nice area for bringing together modern evidence and modern theory. There are differences, as I said, significant differences between age and demographic type. And we're going to suggest, in fact, tagging taxes according to the age at some parts of the tax system towards age of both children and people themselves. And most tax systems have some tagging in them. Typically, they go exactly the wrong way, but we're going to suggest setting it up so they go the right way. Okay, let me look at this a bit. I won't spend too much time on this, but when you're putting the evidence together, this is just a bit background on the UK, but let me give you some budget constraints. So this is typically what a lot of simple research does, certainly at the IFS, and in the handout puts them all together. I'm just going to build it up here. This is a tax credit reform, in fact, in the UK, called Working Families Tax Credit, but it's an EITC. How does it work? Well, this is a person, in fact, it's a lone parent with earning the minimum wage, a low-earning person with a family, and if you're a low earner with a family, if you go into work, you get a big supplement, which is WFTC. If you take a part-time job, it jumps your salary. It's the most generous tax credit system on the face of it. It more generous than the American system, EITC. And by the way, these kind of tax credit systems are now prolific across Europe, Australia, New Zealand, lots of places, and I'm sure they're going to be important, lots of places. In fact, we were involved in a design of a similar thing in Singapore, because this whole issue of low-wage workers, redistribution and work becomes key. But the system isn't this simple, of course. There are lots of other parts of it. In fact, we pay income support if you're out of work. You don't get nothing if you're out of work with a family. And all of a sudden, it doesn't look, the incentive behind the tax credit system doesn't look so generous anymore. If we put all the other benefits together, so we look at the whole system, in fact, it's very flat. And so the first thing we did in this review, but it's been a kind of part of all our research really, is to look at the way the whole tax and benefit system affects incentives overall. And of course, when you put it together, it's in fact a very flat budget constraint. And so there's some very, very high effective tax rates in the UK system, like many other systems. And the question we asked, is this the right kind of system, or are there better ways of designing it? And one way to think of that is just to draw the effective marginal tax rates for different family types. So, in fact, the two that are slightly shadowy are for families on low income with children. And you get very, very high marginal tax rates. This would be true in many, many modern economies. You're trying to redistribute to families with children. Then you take away from them very rapidly. This gives a very high effective marginal tax rate. For a long wage of employer cost or earnings, tax rates of 80% on average or more, which of course is not going to induce very much work from those types. And the idea, the kind of challenge in the review was to redesign this a bit so you keep some redistribution, or as much redistribution as you can in the system, while providing incentives where they're most likely to be effective. And the way we did this in a nutshell is to look at where responses are highest and say, well, here's a good example. We take redistribution to families with children. It turns out that where people are particularly responsive are as children are going to school, around the ages of 5 up to 11. And so what we suggest is that you reduce the effective tax rates around those ages, and but you redistribute. You do all your redistribution when the children are very young. And so this is a kind of movement of resources to when children are very young. As children age, you reduce that reallocation, which gives incentives to the parents to work, but you've done all your reallocation to early years. Of course, this kind of lines up quite well with the idea of allocating resources to early years for children, but that wasn't the main reason. The main reason was just to look at response elasticities. You'd think, well, you know, would this be an interesting policy? Well, this is another policy that's been quite successful, and the government in the UK has kind of switched its tax policy to pretty much follow this now, because once it saw incentives like this, it had to do something about it. And you can do the same for participation tax rates. So the kind of implications for reform that you get out of this, one is you get this very clumsy mix of taxes and benefits, and that's where the integration of single benefit comes in. It's very easy to design, in fact. Secondly, work incentives should be targeted where they're most effective, and for example, what we know about behavioural responses means testing for some groups should be less aggressive, and we pick out 2 groups. And we simulate these to show you can get quite big responses, especially around retirement as well. You know, if any of you studied kind of modern European and North American economies, the incentives around retirement are very heavily towards retirement, so in the age range 55 to 70. And this is largely through the way the tax system interacts with the pension system. And what we've done in the review is switch that around completely to try and provide some more incentives at that point. And that's the example. What about top income? So I'll go through this, and then I might just pause because there are lots of other things I could talk about. But this is quite a fun way of thinking about reform as well. I think someone mentioned this great picture. So even at the top of the income distribution in the UK, as in many economies, you get some bizarre shapes for marginal taxes. We have 2 tax systems, a national insurance tax system and an income tax system. And these effective tax rates can go well above 60% actually in the UK, and certainly around well above 55% on top incomes. But if you looked at this shape, it's very unlikely this would be the optimal tax system, and we spend a lot of time suggesting a more coherent system. But then, even if you were to flatten these out and make them a progressive set of taxes with income, this is quite high income, by the way. This is employer costs per year in thousands, and we're already, where these blips come in, are about 100,000 plus. So we're talking about the top 3 or 4% of the income distribution. So this is the top tax rates. And in fact, most controversially in taxation at the moment in the UK, apart from right at the bottom, is exactly what you do at the top of the tax system. So how might you think about that? Well, suppose we just think of the top of the tax system, top incomes as we're just thinking about the top tax bracket. So we've got a top tax bracket. At the moment, that's now at 50%, which if you include employer costs and VAT, that's quite a high rate, in fact. How would we think about that? Well, it's very easy to work out what an optimal tax should look like in a very simple case, and this is one I really like, and it's very easy to check. So the optimal tax rate would follow this simple formula. Where do you get that from? Well, if you think about it, how would you want to set the tax rate on the top bracket? Well, the highest rate you want to set would be the rate which produces the maximum revenue. That gives no kind of welfare weight to the top because they're rich anyway, if you want. And you just think about what would be the tax rate at which you would maximize the revenue you're getting from that group. You probably want to set it a little bit below that because that's a high rate. It gives no welfare weight to that income. But it gives you a good guide. If you have that as your idea, then there are only two parameters you need, in fact. And one is the taxable income elasticity, and this is why the taxable income elasticity, certainly the top, has become such a controversial parameter. I don't know whether people measure it in Thailand, but if you've got tax records, it's not so difficult to think about how you might do this, and I'll show you what we did. The other is the number of people, the distribution in the top. Obviously, when you're thinking about the revenue, you're thinking about an elasticity and the distribution of earnings. They're the two parameters. And A is the Pareto parameter. Well, if the top tail is a Pareto distribution, then this is the formula. And I'll show you how that works. Well, the two, these are what we get for the UK, 1.67 for A, E is 0.46. I'll show you how we get those. If that was the case, the top tax rate would be about 55%, including everything, which is a little bit lower than we currently have. So the idea would be is that certainly it's hard to think of raising the top tax rate. It's unlikely that you'll get more revenue if you were to do that in the UK, which is a very controversial result. It's purely empirical. So let's look at the empirics quickly. Well, one is the Pareto tail a good approximation? Yes, it is. Here's the actual distribution in these very high earnings numbers. This is the tail of this is the probability density on a log scale, which it will give you the asymptote to the, this is the way you think about it when you're checking a Pareto. And the red line is the Pareto distribution. Pareto always does a great job with the top tail of the distribution. And the Pareto is summarized by just one parameter. And so it's very nice, and it's the A parameter. So that's good. We can measure that. So this is simple empirics, but quite fun. This is just the tax return data that we get now from the inland revenue that we didn't used to be able to have, but now we've got the panel of all tax returns. I'm sure you could get similar things in Thailand, and we get similar things across different economies now. It's the problem is, how do you think about taxable income elasticity? Well, here's the this is the period from 1962 to 2002 in the UK, where there were quite a lot of reforms to the top tax rate. The little diamond things there are the share of the that's the top marginal tax rate for the top 1%. And during the 70s and 80s, way back, I know, the tax rates on the top were around 80%. Okay, and then we get a shift down to 60 and then down to 40. In fact, now we've had a shift back up to 45 and then 50, but that's not in the data yet. Just getting that. So there's some shifts down, and the little black dots going up is the top income share, which goes up. And so you might think, well, causally it looks like one thing goes down, the other one goes up. That's an elasticity. It's not a very rigorous way of getting an elasticity, but it's the way a lot of people did it, in fact. And in the beginning of this debate, this is effectively what people like Marty Feldstein and others were doing to show that, in fact, the elasticity, if you just do an elasticity of this kind of thing, you get a number of about 0.7. In fact, Marty originally got numbers over 1. If you think about that formula, that's going to give an optimal top tax rate quite low. In fact, typically around 30% or something like that. But you can see there might be a problem with this analysis because the income shares keep going up even when the tax rates stop going down. And so, of course, there are other things driving income in the top share of the top 1%, not just taxes. So the one simple way of doing this that isn't brilliant, but it's the way we do lots of things, of course, is to just compare this top group with another group that didn't have the tax reform, the next percent. Simple difference of differences, you might call it. And we did that, and in fact, I'll just give you an example, forget about all the figures. If you do the full time series, just looking at the relationship between the two series, like a macroeconomist might do, you get a number of about 0.7. If you do a comparison with a comparison group that's reasonable, the next part of the distribution that wasn't affected by the tax rate changes, you get a number of about 0.46. Interestingly, Raj Chetty at Harvard's just done a big analysis of all these taxable income elasticities around the top and comes up with a number of 0.44 of his favourite, so we're pretty close here. So we think it's probably around that. It's very important, though, to get this right, and you can see from the standard error, which is the thing in brackets, it's not very robust. And so a lot of attention now is going into getting this right. But an elasticity around that level, we use 0.44, would suggest there's no room for raising the tax rate at the top to get more revenue. But of course, that's not the only thing you can do here. And one thing we learned from this is that the elasticity isn't some constant log, some constant given in a kind of natural sense from any particular type of economy. In fact, it depends on the tax base, because what it tells you is if you increase the tax, what happens to taxable income. And that's not just the people changing their effort and hours of work, it's looking at tax avoidance, putting their income into different forms, and so it depends on the tax base. And in fact, that's what the way we think about this reform. Limits to tax rise at the top, but base reforms. So you'll find in the review a huge emphasis on looking at aligning the tax rates across different income sources, because that's exactly why the elasticity is relatively high at the top, because it's relatively easy to move your income across different sources. And that's an inefficient way of designing a tax system, in fact. And so particularly to avoid revenue shifting. And so a suitable alignment of personal and corporate tax rates then can equalize the tax treatment of income derived from employment, self-employment, small companies. These are all different ways of supplying your effort, and unless you've got a really convincing reason why you might want to tax one different from the other, we go through lots of them and how you might want to tax them differently. We argue that you don't want to do this thing through the tax system. If you want to incentivize small businesses or you want to incentivize entrepreneurial activity, there are much better ways of doing it rather than just a blunt instrument of changing the tax rate on small businesses, for example. Most small businesses, of course, are not growing and they don't particularly deserve a different tax rate to anyone else. So there's that's the idea. And then by doing that, you reduce incentives to convert labour income into dividend income and capital gains. So this is another way how you begin to bring all the bits of the tax system together. There's a lot of evidence used in this because many, many countries have played around with this. And you can see as you play around with them, people shifting their incomes. And the US is particularly poor at this because it has many, many exemptions across different types of capital, including housing being particularly attractively low taxed, and that's another example. Of course, once you've done that, you don't have to worry quite so much about avoidance measures, and this is what I say here. So I'm tempted to actually stop here. I've just run through the other things, but I'm going to do this very briefly because there are two other things that fit together with this, which I can talk about, but I think it's quite fun just to I'll give you a review of them very quickly rather than the detail. Yeah, good. One of them was just on on VAT. The VAT question is very, very important because as VAT rates go up, any exemptions and zero rates are absolutely key. There's a huge difference now. And we have two big exemptions in the UK which are very important for the economy. One is on food and the other is on financial services, neither of which are in the VAT system. And we propose they should both be fully in the VAT system. And we come up with reasons and ways of doing that. And of course, on the financial services side, you have to do this in a coordinated way, but given some of the kind of strange taxes on financial services that are being suggested at the moment, it's kind of bizarre that they should be outside the VAT system. By the way, the VAT system's a very beautiful system when it comes to international trade, because VAT is designed specifically so that if you're trading with a country that doesn't charge such a high VAT rate, then it doesn't provide any distortion. So you can implement this thing, say, in the whole of the EU, while if you're trading with a country that has a lower financial services tax rate, then of course because you exempt things as they go abroad in a VAT system, then that works quite well. It's a destination principle. The other thing is on food as well, and these are the kind of costs. The UK is a particular case because it has the narrowest base, certainly in the EU, and so we spend a lot of time thinking about why you might have distortions, and I won't go through them, but there's good reasons on externalities, on interaction with the labour market, and we go through those. And then what we do, and this is where the empirical thing comes in, we say, well, here's a reform, we're going to design it in a way that leaves the distribution of income just the same. Because the theory tells you that you can always align rates across commodities to give you the increase in efficiency in the running of the tax system and leave work incentives and redistribution just the same. So the nice thing about a kind of simulation micro-based model is you can see whether that works. And so here's a VAT reform. This is increasing the VAT on food, actually, in the UK, just to show you how it works. And this is the rise in expenditure. You can see it hurts the low incomes much more than the high incomes. It's a regressive tax. As it stands, it would be a regressive thing to do. We come up with a reform that is changing the rest of the tax system. So you move from the taxation of food to redistributive taxation on direct income, and it completely compensates, at least on average, and we show how it does for particular groups. So that's great, but of course you can compensate people and not leave work incentives the same. You could give lots of means-tested benefits. And the theorem, Atkins and Stiglitz theorem, says you can compensate and leave work incentives the same and get the efficiency gains. And so we do that. We show how, in fact, this is our reform, and that's the effect on effective participation tax rates, so almost no effect. So what we show is that it's quite easy to replicate what we get from theory, in fact, using data. That is, by designing a compensation package that gets the compensation right and work incentives unaffected and gets the gains from a broad-based VAT. This might seem very simple, but we couldn't find anywhere that really came up with exactly this. There's always a lot of discussion of compensation, but never a discussion of compensation and work incentives at the same time, which is what you need for the theory. So that's one little bit on that, and it's one side of that. And we look at welfare gains, of course. And then the other is taxation of savings. And here's the other kind of idea. Consumption tax. At the moment, we have some aspects of the tax system of savings that are consumption tax based, and some that are not, that come in through the income tax. And probably the worst example of this is capital gains taxation, which is pretty poorly designed in most countries. And one of the ideas in the review was to come up with a new way of doing this. Of course, the one way to get corporate capital gains tax right is to do everything through consumption taxes. But it's hard to do everything through consumption taxes because you want to do some redistribution. So income taxes come in somewhere. And the key is to set up an income tax system that allows you to also effectively replicate consumption tax through income tax and treat capital gains properly. And just to give you an idea, why is it that capital gains come to so much problem? Well, if you think about what an income tax system does, an income tax system effectively taxes savings twice, of course, because you put your income into savings after you've paid tax, and then when you take it out, you pay tax again. So there are lots of ways of getting around that. The problem with capital gains is that if you think about it, what happens is that as you accumulate your capital gain, if you've got an income tax system, then it clearly is it puts an extra tax on capital gains, and of course it gives you this lock-in effect. That is that if you keep your income in tax, there's an incentive to keep your income in capital gains and not to take it out evenly, and that gives you this kind of capital gains bias. Anyway, the idea here is that what we come up with, and I'll just give you that idea. We come up with a thing called a rate of return allowance, which effectively takes the income tax system and gives you an allowance for anything you do, any assets, any saving you do. It's a very simple thing. It's already often used when it comes to corporate taxes, just a rate of return allowance, and you do it for consumers and savers as well. If you do that, that immediately lines up tax rates across different assets and gets around the problem of taxation of capital gains. And we show how that works. And so this is a kind of important idea. There are some economies already experimenting with this. Norway is one example, by the way, but not many yet, and we've still got to persuade people to do this. But I think there's such a mess now with capital gains across many, many different economies that this is one area where we think it would be quite important, and we spend a lot of time in that. Now, all of these things are equivalent, but of course, the nice thing about rate of return allowance is you can have a standard income tax, give an allowance for savings, and so you can be progressive while still moving towards, while still effectively having a consumption tax base, and the combination of those two is part of the aim of the review. A standard income tax never gives you this, gives you all the distortions towards debt, away from equity, against capital gains. So that's why we typically have a lower rate on capital gains than other taxes, because it's felt that capital gains are being unfairly treated, especially when there's inflation. If you have one of these things here, it's going to be neutral, and it won't be affected by inflation. So all of these things, this is an important aspect. And we spend a lot of time on this. So overall, there's when it comes to it, and I wanted to just point this out, the idea is to kind of produce an integrated set of reforms that integrate what you're doing with earnings, with corporate taxation, with savings. I haven't kind of gone through the detail, but that's what you find. And there's the last chapter in the book, chapter 20, kind of brings together this kind of integrated picture. And we were discussing at tea, it's, from our point of view, it's always nice to have a reform that is completely coherent. Of course, you're never going to get a government to introduce such a reform. On the other hand, if you don't think about reforms like that, then you get this piecemeal approach to tax reform. And right at the beginning of the review, we showed how piecemeal reforms have typically not been a very helpful way of tax systems evolving. Sometimes they go in the right direction, sometimes they don't. So the overall, having at least a shape of the whole package, then you get some idea here. It doesn't mean to say you have to do everything at once, though. You can do some of these reforms in a kind of stepwise production way. And we've certainly seen some of this happen. Interestingly, the broadening the VAT base I always thought was a complete taboo, and it used to be. But with the financial crisis, there's so much demand now to raise revenue through some taxation, getting the tax system efficient, and the change in the structure of taxation has become quite a topic, an open topic of discussion, and we see a lot of discussion of taxation of financial services and some move now to broadening the base of VAT. As I discussed at T, even in the US now there's discussion of introducing VAT, just in a sense because there has to be something to increase the tax base there. So this is overall idea. I talked about the how different evidence has been used in coming up with these reforms and these different margins, and I think I'll leave it there. If you want to follow any of this up, it's all online. There's always too much in this review to talk about in a seminar. I've focused on a few things, but you're welcome to ask me questions or follow up on any aspect of the review. Thank you.
If any participants would like to ask any question or share ideal experiences, please raise your hand and I will bring the microphone. Or you can go to the main microphone there. Yeah, please.
Ooh, somebody.
Vasilis.
So I have a question which is about, obviously it was a very short time, so probably you didn't have the time to touch upon that. So it has been widely argued that public policy, and in particular the implementation of good tax policy, depends on both the improvement of legal processes and administration. So my question is, how could we go about thinking about improving both tax policies as well as legal processes and administration? And would there be any differences if we would like to apply that in developed or developing countries? Thank you.
Thank you. Good question. Shall I just answer, try my best? Good. I mean, part of the objective, and you may have seen it kind of coming out of discussion, was to raise some of those issues, like tax avoidance and complexity. So the idea of thinking about the tax system as a whole and then looking at how complex it is and how people understand it. By the way, there's quite a lot of discussion of that in the review. We find that it's quite clear that although we think of an effective tax rate as putting all these taxes together, agents in the economy don't recognize it quite like that. There's different transaction costs and there's different hassle and stigma costs with different parts of the tax system. And so part of our objective was to combine and unify wherever possible so that you got a simpler universal or integrated system. And that can be very important for a number of reasons. It helps on the administration, by the way, enormously, because you're not administering the tax system through firms, through individuals, through different types of benefits. You're trying to do it in one coherent whole. The lining up of the rates is very important on tax avoidance. You know, we had tax lawyers on our committee, by the way, and most of their income is made up made from advice on the best form of tax avoidance. And tax avoidance is typically because you tax very similar things differently, like different assets, like housing, different kinds of assets and activities are taxed differently. Then there's, of course, a lot of time spent on advising individuals on how best to organize their incomes to minimize their tax bill. And there's a lot of revenue shifting involved in that, and a lot of people spend their own time doing that. I think there's some great examples around Europe of that, and I think the way the Greeks used to tax the building of houses, which was a roof tax rather than a housing tax, so many buildings were left without roofs, is a good example. But that's how. What about specific? So there is a practical dimension to the whole reform package, although we are economists, so we're not supposed to be, we're not, of course, going to be able to talk about the precise design. And there's a political economy to this. We, in the debate over financial services, we much prefer a VAT on, effectively a VAT on financial services than a financial transaction tax. But the political economy of that is very difficult, actually, because people think that a financial services tax, which is like a VAT, hits consumers, whereas a transaction tax hits businesses. Well, of course, we know that's probably not the way it actually happens. But nonetheless, getting that argument over about instance is very important. And we haven't won that, by the way. There's still, as you might read in the press, a lot of pressure to have a financial transactions tax rather than move the financial services into a proper VAT base. You might want to do both, by the way, but it's very bizarre to have it outside the VAT base, actually. So there's good examples there. What about developing economies? I suppose the big difference there is the informality of the economy and how that affects the way you do tax design. We certainly spend a lot of time worrying about that. Not in this review particularly. We worry a little bit about the shadow economy and black economy and informal activities, but it isn't a huge worry. Of course, one of the attractions of VAT through the chain is that it can cut down informality. It can make the incentive for informality. In connected economies, very much lower. The idea is that even if you're a small guy, who might generally have a big incentive to work outside the tax system, if you're buying things from somebody who's paying VAT in your chain, of course, if you want to recover the VAT on the things you're buying, then you have to be part of the VAT system. And so the chain effect in a connected economy, connected supply route, has a big incentive to join the formal system. So the more connected the supply routes are, the more likely VAT will be quite a good incentive to keep people in the firms and self-employed in the formal economy. The problem with developing economies is often there's a big part of the economy which doesn't have many stages to production. It goes straight to the consumer. And of course then VAT doesn't have any advantages there. And it's very hard to get that part into the VAT base. So that's one example. I mean, the typical argument here, though, is it's still a good idea to be thinking of commodity taxes as the main tax base. So if you're thinking about Mexico, for example, which we have quite a lot, the income tax base is very poor, and it probably is going to stay quite poor. The VAT base probably could be expanded quite a bit. And then the issue is, how do you do that in a way that preserves a relatively progressive? And at that point, you might still want to have distortions across goods. It may well be because you can't do the redistribution I described at the end here through an income tax system, it may be that the VAT system has to have some redistributive elements in it. And it's somewhere like Mexico where you would want to have perhaps lower rates of VAT on necessities. And that's a good example there. So you get some of the arguments here, the broad base of VAT, or at least using VAT to establish a tax base. But it's still, we know from Europe, it can be for self-employed and for businesses that don't have many links, VAT still it isn't a secure way of getting the informal economy. So the informality is the big issue. And I think the key point, though, is as economies grow, the production process gets more integrated, and and you can design a tax system that has quite a big incentive for people to join the formal economy. I think this has happened quite extensively in Brazil, for example, where there's still a big informal economy, but they have a very developed VAT base, for example, and that VAT base has been growing quite substantially as the economy grows. So we don't spend a lot of time in developing countries in this review, but that's a long answer.
Okay. Anyone would like to ask any questions? I will bring the microphone. Yeah.
I just wonder how all this is designed on the basis of tax efficiency, and how does it aligns with the government policy to promote certain class of assets? You know, how government said we want to promote, you know, the real estate or property because it has externality, and that's usually the reason why there is different different tax regime for different assets. And how do you consolidate these two different objectives?
I mean, well, yeah, it's a good question. And we do look at those cases. I mean, so this is where you look at deviations from neutrality. It may be across assets. And our argument generally is that most of those arguments that were used for taxation of different assets differently are pretty poor instruments to achieve the ends that are typically being sought after. I mean, a good example is small businesses and entrepreneurial activity. And we look at that quite closely. And so we come up with, our reforms are about the way you tax investment allowances and R&D. So we suggest that it's a much more targeted approach where you give like our rate of return allowance, you have the same thing for firms. We come up with a dual set of tax reforms. And for small businesses, there are kind of two key aspects. One is credit constraints. And of course, the way the tax system taxes investment income you raise for investment and profit is key there. So the idea is to allow investment allowances against tax. So that's a kind of obvious point, but it means that you get full offset of taxation of investment up to some level, and that if you couple that with R&D type incentives, then we argue that's a much better way of incentivizing that particular activity, because if you just look at small businesses, there are huge numbers of small businesses, most of them not growing or doing anything to do with particular entrepreneurial activity. And so just by having a lower tax rate on that whole group, of course it's very politically popular perhaps, but one thing it does is incentivize just that kind of organization of activities. So lots of firms outsource to small self-employed because the tax rate is lower, and it reduces the tax base considerably. So the idea is you think of the externality you're trying to target, whether it be entrepreneurial behavior. In terms of property, I mean, that's very interesting. So if you think there's an externality to holding your own property rather than renting, for example, then you might want to incentivize property ownership. Our view there was that we couldn't think of any good reason for that. There's already a kind of incentive to hold your own property because you can do with it what you like, which you can't do with rented property. So there's typically a bias in preferences towards that. And it's just a matter of getting the taxation of assets right. So clearly, housing is an interesting one. There are two aspects to it. One is it's an asset, the other it's consumption. And it's getting the taxation of those two things lined up correctly. And we spend a lot of time on that. So it's clearly an asset, so you don't want to double tax it. So you either want to give tax relief, or you want to, or you want to make sure you don't charge tax on the income from that particular, from the consumption of that, of housing. So with housing, typically we don't tax the if implicit revenue stream or consumption flow from that. Okay, so that's why it's very, it's highly, it's biased in favour of property to have mortgage interest relief, and not taxing the return as well. So many economies like the US don't tax on the way in, they don't tax on the way out, so they make property extremely attractive asset to hold for tax reasons. And we couldn't find a good reason for that. You clearly want to line it up properly so that it's not distorted one way or the other, but that would be the argument. But our view generally is that, governments and politicians come up with many, many arguments for particular taxes, and we argue the bar should be very high, because typically what happens is if you change the tax rate on something that's very similar to something else, there's a lot of shifting into that. And that's a huge loss of tax base and a very inefficient way to tax assets. And we come up with lots of examples of where that's happened, and so we say the bar should be set very high, and we hope by raising these issues we kind of make the argument against particular tax wheezes, we would call it, much stronger. But that's right. Yeah, so if you've got a good argument for an externality, clearly you should change the tax system to suit it, but you've always got to be worried about the offsetting effect, the revenue shifting effect. Yeah.
Thank you, Richard. I think you propose to implement value-added tax on financial services. However, in practice, it would be quite difficult to implement value-added tax on any financial services. Let me share some experiences on Thailand. When we implemented a value-added tax in 1993 to replace the overall sales tax, we thought about having value-added tax on financial services. But in practice, it's almost impossible to tax on financial services. That's why we introduced the so-called specific business tax instead. So we compare if we introduce value-added tax on financial service, and we try to generate the same revenue and to abolish any distortion between financial services and other services. In that case, we implement the similar type of sales tax, and we call it specific business tax, to tax on income on financial services. So in practice, if you propose to have a value-added tax on any financial services or insurance, what would you recommend in practice?
Well, we don't propose a straight VAT for the reasons you said. We probably propose something rather like what you may have already. So there's two things. One is insurance, and typically insurance premiums are already taxed a bit. So there's, but all we're suggesting here is that once you think of a VAT as effectively a VAT on profit flow with a different adjustment for labour, offset for labour, inputs, then you can just treat the financial services industry in the same way, but you don't charge a VAT directly on the services. You charge the equivalent on the profit flow. It's not perfect, and this discussion, the IMF have also put out a paper which looks at the same thing, So financial activities tax is what we're proposing, very similar to that. The only difficulty, the difficulty of once you move, and you probably had the same problems, if you move out, if the beauty of a VAT is that, when I buy an input, I know what VAT is paid, I can offset that, and you get this very nice accumulation, so the final product is all that pays the VAT. If you do it through a business tax, that's harder to do, because if I buy a financial service, it's not so clear what VAT is buying. So you have to have some offset in this for firms buying financial services from another firm. I don't know how you do that, but how you do it in Thailand, we just suggest, like IMF has suggested, you have to come up with some arbitrary rule that doesn't make it a perfect VAT, but it becomes close enough. In the end, what we say is that those kind of things, you want to spend a bit of time thinking about how to get it as close as possible. But at the moment, of course, when we have a 20% VAT on other goods and then 0 on financial services, some small thing on investment, on insurance premium, but nothing like a full 20% effective for VAT. You could redesign the tax so that it becomes as close as possible. It's interesting you say that's what you do, because it might be a good one to look at. It seems a much better thing to do than just going at transactions, which typically you might want to do if you think there's some negative externality from transactions themselves. But I think most of the argument about tax in financial services is that the profit flow is not taxed in a reasonable way. And of course it isn't, because it's outside the tax system. I mean, a question back to you, which would be an interesting one, is you're doing that locally to Thailand. So how does it work relative to other countries? And that usually the problem is how you coordinate something like that when financial services are being supplied across jurisdictions. For England, that's a big issue, because London is a big financial services provider. So we have to also have the ability to offset if you're supplying, so you don't distort the playing field if if they were supplying services to a lower tax jurisdiction, we have to make sure that those are lined up. So there are the international point and the transactions between companies, which are perfect in a proper VAT, but you have to redesign them. There's 3 or 4 chapters on that there's one whole chapter on that design in the review, which we spend a lot more time on than we thought, because it became such a hot topic. And we also thought the political economy of it was quite important. When you're thinking of broadening the base, if you just talk about food, it sounds very regressive. If you talk about, there are many things that are outside the VAT system which should be brought in to level the playing field, if you want, on production of those goods. Including financial services, but I agree. Well, that would be very interesting. I mean, the way the French do a similar thing, but it's a rather bizarre thing. So they have a higher tax on high incomes in the financial services industry as one way of trying to get around this as well. So lots of countries have specific taxes because they realise that financial services isn't part of the VAT. I think what's happened in the last 5 years or so is that there's a lot more effort into how to design something as close as possible to a VAT. It's interesting, if you go back to Mead, of course, he proposes, the background to this is that if you just write down in a regular style of model, where, of course, regular economic model, there is no value added in the finance industry, because there's no value added in money. And so if you write down a standard competitive model, you have no VAT, you have no value added in the financial sector, so there's no need to have a value added tax. But if, of course, there is a service being provided, and that service has value added, and that's exactly and you can see that through the profit flow in the industry.